Okay, now we will continue our analysis of macroeconomic models, and we're going to follow on the long run aggregate supply using the two perspectives, the Keynesian and the neoclassical perspective overall. And let me share the screen here to keep going with our presentation. So let's summarize what we have seen using, remember, the business cycle. And the business cycle was telling us that that over time the economy performs in a certain way, but there are some fluctuations that take place over time. Just go back to the screen sharing because I need to put the volume on the screen. Good. So what we will see is that the long run trends the long run trend is determined by the short run fluctuations that happen in an economy over time. So we want also to define the idea of the structural change of the factors of production of the economy versus the short-term fluctuations. So a structural change will be, let's say, a destruction of the factors of production, for example. But a fluctuation is just a temporary shock that is making people to consume more, or the government investing more in public services, or everything together, as we have seen from the aggregate demand perspective. But also we may have also some short-term shocks from the aggregate supply perspective, and all these shocks could be short-term, and those are going to be the fluctuations that we see reflected in the business cycle. Okay, so because of these short-term fluctuations, the economy will tell us how much it is performing in terms of GDP production over time. If there's a destruction of the factors of production, then the economy is able to produce less, even if there are some fluctuations over time anyways. So very quickly, we go to the business cycle here. Remember, we just draw time, and we draw GDP here. And we said that if the economy was having these fluctuations in the short run, remember, this time could be expressed in years, in decades, or in months, but we are reflecting how the economy is performing. GDP 1, we may have here maybe GDP 2. So depending on how are we measuring the time frame, then we will refer to our long run according to how many years or how many months are we looking at in our analysis. Now look at this. This is our long run trend. Remember, we said that the long run trend is actually this average, or this line of best fit of the short-term fluctuations. We're taking away the fluctuations and we're trying to put an average here. So what comes to your mind maybe is that this long run trend is actually the ability of the economy to produce over time, and these will be the fluctuations that are gravitating around the trend. The trend is determined by these fluctuations, okay? Some years we may produce more than our trend, and some years we produce less than our trend. Remember that anything below the trend is what we were producing below. Anything above during a boom is that we're producing above our trend. So if you have in mind what we have talked about, our long run aggregate supply, the long run trend actually is reflecting the ability of the economy to produce over time. And we may have some extra production sometimes, but then it will go down, and we may produce below the trend sometimes, and then we go up. And then again, these fluctuations are what is determining our productivity over time, or our capacity to produce over time. In other words, based on the business cycle, we can look at the potential PPF of a country. Remember, we said the PPF on this perspective is seen as the average of the production over time of an economy, and how it is gravitating around a certain value of the economy that sometimes is more, sometimes is less, but in average will be this amount that we call the PPF, okay? And remember that we also said according to the neoclassicals, the full employment level is actually this trend that is telling us, okay, this is how much the economy is producing in the long run. But this production is determined by the fluctuations of the short-run aggregate supply and aggregate demand, shifting in or out, or this equilibrium point, let's say moving up, moving down. So the macroeconomic equilibrium could be below the full employment, above the full employment. If we put here, point A will be down here, point B will be up here because it's above the full employment. And so this is gravitating around the long-run trend. Or also we can just add the fluctuations from the aggregate supply in the short run. So now this is very messy, but we have the idea here. What is happening with the economy is that aggregate supply and aggregate demand are shifting in and out, and they are creating different equilibria over time. And these different points of equilibrium are the ones who are determining the long-run trend, okay? Keynes was mentioning that this macroeconomic equilibrium also is enhanced with what he called the animal spirits. And the animal spirits are basically the instinct of people to behave like the herd, okay? If the herd behaves in a certain way, according to Keynes, that is leading to individuals also to behave in that way. If people see that the markets are facing downwards, people invest less in those economies because they feel that investing in that economy is not the best thing to do. So they will cut investment, and that will actually, in turn, create more downward slope in the production of the country. Also, the consumption may be induced by the animal spirits, because if people say, well, I should rather save instead of consume because right now the economy is facing a downward slope, I may receive less money in the future, there may be a recession coming. So what's happening right now in the world, many people are just stocking up, but they will consume less overall because they want to save money if there's a recession coming. So the animal spirits will enhance the downward turn of the business cycle. But also they may enhance the upward booms, because once people are finding that consumption is going up and you have confidence in the economy, then you will consume more instead of saving. You will use more your money. You are confident that in the future you still have money. Also, investors will invest more. Maybe governments will start to invest more because they have these prospects of future growth, etc. So all of that is related with this idea of animal spirits and the herd behavior that Keynes was talking about. I just want to mention, because the next slide has a small video that I want to show you and refers a little bit to what we have been talking so far. And there are some concepts that we will actually revisit a little bit later that you will hear on this video. So let me show you the video that is more putting everything together from the two perspectives of Keynesian and neoclassical views.
Lord Keynes, welcome, sir. It's a pleasure.
The pleasure's all mine.
Your agenda.
That won't be necessary. I am the agenda. Tell them I've arrived.
And then tell them I've arrived.
And your name is?
Hayek? F.A. Hayek. With an H.
Freddie.
Yep.
Keynes,
Hey, listen, party at the Fed.
Already?
20 minutes.
Lobby.
John Maynard Keynes.
F.A. Hayek.
Yeah, we're opposed.
We oppose each other philosophically.
In the same studio.
We've been going back and forth for a century.
I want to steer markets.
I want them set free. There's a boom and bust cycle and good reason to fear it. Play low interest rates.
It's the animal spirits. John Maynard Keynes wrote the book on modern macro. The man you need when the economy's off track. Depression, recession, now your question's in session. Have a seat and I'll school you in one simple lesson. Boom, 1929, the big crash. We didn't bounce back, economy's in the trash. Persistent unemployment, the result of sticky wages. Waiting for recovery? That's outrageous. I had a real plan, any fool can understand. The advice real simple, boost aggregate demand. C-I-G, altogether gets to Y. Keep that total growing, watch the economy fly.
We've been going back and forth for a century.
I want to steer markets.
I want them set free. There's a boom and bust cycle and good reason to fear it. Play low interest rates.
No, it's the animal spirit. You see, it's all about spending. Hear the register cha-ching. Circular flow, the dough is everything. So if that flow is getting low, doesn't matter the reason. We need more government spending. Now it's stimulus season, so forget about saving. Get it straight out of your head. Like I said, in the long run, we're all dead. Savings is destruction, that's the paradox of thrift. Don't keep money in your pocket or that growth will never lift. Because business is driven by the animal spirits, the bull and the bear, and there's reasons to fear its effects on capital investment, income, and growth. That's why the state should fill the gap with stimulus, both the monetary and the fiscal. They're equally correct. Public works, digging ditches, war has the same effect. Even a broken window helps the glass man have some wealth. The multiplier driving higher the economy's health. And if the central bank's interest rate policy tanks, a liquidity trap, that new money stuck in the banks. Deficits could be the cure you've been looking for. Let the spending soar now that you know the score. My general theories made quite an impression. Revolution! I transformed the econ profession. You know me, modesty, still I'm taking a bow. So say it loud and say it proud, we're all Keynesians now.
We've been going back and forth for a century.
I want to steer markets.
I want them set free. There's a boom and bust cycle and good reason to fear it.
I made my case, Freddie H. Listen up, can you hear it?
I'll begin in broad strokes, just like my friend Keynes. His theory conceals the mechanics to change. That simple equation, too much aggregation, ignores human action and motivation. Yet it continues as a justification for bailouts, payoffs by poles with machinations. You provide them with cover to sell us a free lunch. Then all that we're left with is debt and a bunch. If you're living high on that cheap credit hog, don't look for a cure from the hair of the dog. Real savings come first if you want to invest. The market coordinates time with interest. Your focus on spending is pushing on thread. In the long run, my friend, it's your theory that's dead. So sorry there, buddy, if that sounds like invective. Prepare to get schooled in my Austrian perspective. We've been going back and forth for a century.
I want to steer markets.
I want them set free. There's a boom and bust cycle and good reason to fear it. Play low interest rates.
No, it's the animal spirit.
The place you should study isn't the bust, it's the boom that should make you feel leery. That's the thrust of my theory. The capital structure is key. Malinvestments wreck the economy. The boom gets started with an expansion of credit. The Fed sets rates low. Are you starting to get it? That new money is confused for real loanable funds, but it's just inflation that's driving the ones who invest in new projects like housing construction. The boom plants the seeds for its future destruction. The savings aren't real, consumption's up too, and the grasping for resources reveals there's too few. So the boom turns to bust as the interest rates rise. Where the cost of production price signals relies. The boom was a binge, that's a matter of fact. Now it's devalued capital that makes up the slack. Whether it's the late 20s or 2005, booming bad investments seems like they'd thrive. You must save to invest, don't use the printing press, or a bust will surely follow, an economy depressed. Your so-called stimulus will make things worse. Just more of the same, more incentives perverse. And that credit crunch ain't a liquidity trap, just a broke banking system. I'm done, that's a wrap. We've been going back and forth for a century.
I want to steer markets.
I want them set free. There's a boom and bust cycle and good reason to fear it. Play low interest rates.
No, it's the animal spirit. The ideas of economists and political philosophers, both when they are right and when they are wrong, are more powerful than is commonly understood. Indeed, the world is ruled by little else. Practical men who believe themselves to be quite exempt from any intellectual influence are usually the slaves of some defunct economist.
The curious task of economics is to demonstrate to men how little they really know about what they imagine they can design.
They've been going back and forth for a century.
Okay, so that summarizes a little bit of what we have been looking so far. Let's move. So because Keynes and neoclassical approaches were right, both of them in the long run, this economist called Paul Samuelson came and he actually put together what we call now the mainstream economic analysis, which adds the short run and the long run into the whole analysis in our model. So we call this, sorry, the ADAS model, including the short run and the long run analysis. And we're putting together actually Keynes and neoclassical into the model. So we have real GDP and we have price level, okay? Now remember we said the short run aggregate supply and then the and the aggregate demand together, they will determine actually the macroeconomic equilibrium, okay? We call it Y. And the macroeconomic equilibrium at a certain price level, at a certain period of time or at a certain point of time, this is actually what the economy is producing. We can call it Y0. Now, if for some reason this is exactly the point of the long run trend, remember using our business cycle, I'm gonna draw a little business cycle here, time and GDP. And remember, we had our fluctuations and our trend. Let's say at the point in which the economy is producing actually is exactly the point of the long run trend. That would be this point here. If we had a static economy and always is producing at this equilibrium, we actually will have our long run aggregate supply. And this Y0 becomes at the same time the full employment level. Remember, full employment level is the capacity of the economy over time. And in the long run, all the economy fluctuates or gravitates around this long run trend. Because we're looking just a particular time here, this is not a dynamic analysis that is making the long run trend to move over time, but this is just one single year. The economy produced at the full employment level at this year. And what we can add here is the Keynesian perspective of the short-term fluctuations. So in this case, the short-term fluctuations of Keynes are also reflected here by saying, okay, maybe one year we produced below the full employment level. So only our Y0 instead of here, now this economy was producing maybe because the aggregate demand shifting inwards, maybe, I'm just saying this could have been the shock. That is making the economy to produce at a lower price level. But what happens is that now less people are working, so less resources are being used. So that's why the price level is lower. And this gap is actually what we call a recessionary gap. Recessionary gap, because there's a gap between the full employment and the current level of output, which is actually facing what we call a recession, because remember, this is below our full employment level. So this gap here can tell us the economy can be currently in a macroeconomic equilibrium, point A. This could be a point A over here, but is below the full employment level. It hasn't reached, in this case, in this particular year, it didn't reach the full employment level. But the economy this year is in macroeconomic equilibrium below the full employment level. There are some spare resources between Y0 and YFE. Also, the economy could actually fluctuate beyond the full employment level on another year. This will be up here, maybe point B, let's call point B over here. This is above the full employment. Let's call it Y2. So actually what is happening is that the economy is producing beyond the full capacity. Now this is making pressure on the price level. This fluctuation from, let's say, equilibrium to point B, if this fluctuation is just one of those short-term fluctuations, the economy may come back here, back, and then go back here, and eventually will go up here. So the fluctuations in the short run mean that sometimes we consume more or we invest more. Remember, the government may spend more, etc. Or the opposite, may spend less, etc. So these are just what I drove here are just demand side shocks that are making the economy to produce more or less in short terms. This is not a structural shock of the economy. A structural shock of the economy will be if, let's say that the exports have increased because now everyone in the world wants to buy our goods, and the aggregate demand shifted outwards in a certain level, and we, while producing, actually we are overproducing here. Now, this structural shock is telling us this is the new normal of the economy, but now what is happening is that remember that in the short run, wages have not been adjusted to the new normal. So the price of the goods produced in this economy increased, but because it's not a short-term fluctuation that we may expect the prices to go down or go up, this is actually a fluctuation of prices that sometimes happens up and down. But in this case, the prices are now stuck in a new normal, which is the price level 1. Why? Because people were demanding more our goods from abroad, so the aggregate demand shifted out, but it remained at this point. So we were able to produce more, but this overproduction was beyond our capacity. This can suggest us that we were overproducing based on what our capacity is able to produce normally, but this could be because we are using extra time, let's say more hours to produce whatever we were producing. Maybe the machines are overused. So because the wages and the overusing of machineries, etc., have not been accounted for yet, when we add, let's say, when people start to realize that everything is more expensive now, workers will say, well, we want our wages to be adjusted upwards. They say this pressure of inflation, this percentage change of the prices has to be adjusted to the wages now. So workers are going to tell us, well, adjust our wages to this level, and then when wages are adjusted, what's going to happen? The cost of producing is going to increase. So our short-run aggregate supply will actually shift back inwards because now it's going to be more expensive to produce. And we reach again our full employment level, okay? But now at a higher cost of producing, now we're adding the inflation rate into our cost of production. So this gap actually here from equilibrium 1 to equilibrium 2 is the inflationary pressure that in the long run, this structural change of the economy created. So the resources were not actually available to produce a lot more in a sustainable way, in a sustained way as well, but they have to be adjusted, and then we're producing less. That means that because of higher cost of producing, higher price level, and the production is cut because now everything now is more expensive. So here people are demanding less and less until we reach the point of a sustained level of production. So what we are playing here is with the Keynesian idea, but also with the neoclassical idea that in the long run, once the wages have been adjusted, we reach our full employment back, but at higher prices, okay? The same will happen downwards. If there's a fluctuation, then the fluctuation will actually come back in and out, but if this is a structural shock, now the new normal will tell us now there are people who are not working here, and because the prices are down, these people are willing to be hired at a lower wage. When people are hired at a lower wage, then the short-run aggregate supply will shift out. Okay, now we are producing more, but hiring people at lower real wages until we reach the new equilibrium. And that will be the adjustment downwards in terms of price level if this was a structural shock. Structural shock means a consistent or a permanent change in any of the factors that determine, in this case, the aggregate demand, but also it could be something that changes the whole structure of production from the aggregate supply side. So this is a cleaner graph that is just showing us the neoclassical plus the Keynesian, which is the consensus, or we call it the mainstream model ADAS using the short run and long run approach. So this implicitly has the Keynesian approach, goes down, up, and then it will go up to the full employment if this was the full employment capacity. But we see that also there's an overproduction according to the neoclassicals that are telling us this is possible to produce a little bit beyond the full capacity in the short run. So this model is the one that is now most commonly used to analyze macroeconomic fluctuations and macroeconomic growth in the long run. So the neoclassical and Keynesian combined, remember what we're drawing here is price level and GDP. We have short run aggregate supply. We have the aggregate demand. We have our, now I just draw it for some reasons. The full employment is a little bit above the macroeconomic equilibrium actually. Y0 is below the full employment. That's possible. We can produce below the full employment. So now we can just play with this model by saying, well, the aggregate demand can shift out, can go beyond the full employment. The aggregate supply can actually have a shock, and it could actually go backwards or can shift inwards. So from the equilibrium original that we had here, now we have a different equilibrium. And the reason of less production and higher price level is because the cost of production of this economy increased. So this is how we use this model to show the different impacts on the determinants of aggregate supply and the determinants of, remember, aggregate demand, which are CIG and X minus M. Here is more clean version of how inflation may occur because of an over demand, or we call it demand pull inflation, above or beyond the full employment level, and then wages are adjusted up. And now when they are adjusted, inflation takes place. Productions remained, or they came back to its former level of production, but at higher prices. This is one way of explaining the macroeconomic inflation based on an over demand of goods and services from the consumption side. But we also can use only the Keynesian model. Remember, the Keynesian model was telling us, well, the economy can produce in between these ranges, okay? And these ranges are actually where usually all economies in the world produce. So if the economy has abundant factors of production, will be here. So we may say the economy, according to Keynes, can produce more, let's say from Y0 to YX. The economy can produce more goods and services without having an inflationary pressure, as long as it is where the resources are abundant, okay? So the abundance of factors of production is not really making any inflationary pressure here. Whereas here now we're saying, well, the economy has reached a point that producing more will make a little pressure on the price level. And if the economy keeps them, of the consumers and producers of firms, let's say investment and government and X minus M, if any of these changes upwards, then we're looking at a pressure on aggregate demand. And if the ceteris paribus, again, the resources are remaining stable or fixed, then the aggregate demand keeps shifting out and the price level keeps increasing, okay, price level 3. And until we reach a point, and we can use actually the Keynesian model to show how the economy can be at full employment. Here it will be our full employment according to Keynes. There's no way of producing more. According to Keynes, any shift out of the aggregate demand at this point will only create inflation, which was, remember, what we just saw on the former slide. But this is skipping the point of overproducing and then coming back here. Keynes was saying, well, we have reached a point in which only we are increasing our price level because the economy is not able to produce more at all. So we are okay using this model, just this model, we can use it. We are okay using this model, okay, we can use the short run and long run together. This is the one. So we may say, well, when there's a shock on the aggregate demand, we have the same here, lower price level, lower GDP. So GDP decreased, unemployment increased because between full employment and the new equilibrium, there's more people unemployed or factors unemployed. So if the aggregate demand shifted inward, ceteris paribus, unemployment increased, GDP decreased, price level decreased. So this is also a Keynesian analysis, but using our mainstream or neoclassical model, including the short-run aggregate supply. Because remember that the pure neoclassical was something like this: long-run aggregate supply and aggregate demand only. But this is no longer used. This is just a theoretical analysis. We use this, or we use the Keynesian, this one, okay? So these two are the models we're gonna be using. Now this model, look at this. This is the Keynesian and neoclassical combined. In some books actually use this as well, but you should understand what this is telling us. This is using the Keynesian perspective. Look at this. Using the long-run aggregate supply, but they are referring to it also as the short-run aggregate supply, but with a certain level of output that is maximum. This level of output that is maximum will be the Keynesian view, remember, of the full employment according to Keynes. There's no more production after the yellow sign over there, the yellow highlighter. So this will be our Keynesian full employment level down here, but usually the books don't even bother to refer to it as the full employment because they are saying the economy anyways just fluctuates around this boundary. So in books, you will find that the full employment is portrayed as this average that we were talking about, okay? And the economy will fluctuate around this average, but it still includes the idea of Keynes mentioning that there's a limit of the economy and making the short-run aggregate supply becoming the long-run inelastic, okay? So this is a little more complicated to draw, but I just want to make sure that you understand what this is showing because it's showing the same thing. There are fluctuations from the aggregate demand in the short run, so they actually will move along the short run aggregate supply. But in this case, the short run aggregate supply is also the Keynesian LRAS, but they are using the long run average here to refer, sometimes we can produce above it and below it. And this is almost the same of what we just saw before, that is the consensus model. So I don't really like to use this because it has too much information that we don't use. Sometimes we use either this information or the Keynesian approach that we have reached the full employment level. But this one is, I would say, mixing many things together, okay? Which is correct, is right, but we don't, in order to avoid confusions, we don't really use it in our IBA analysis. Gonna leave it here for questions, and then we're gonna look at some data. So if we go to the next slides, we're gonna just skim or go very fast and just look at how the aggregate demand actually tells us if the economy is inducing its GDP by increasing its consumption or increasing its investment, not only in increasing, but it could be also decreasing, and then therefore the GDP is affected. Is it an export-based economy? How the exports will affect the whole GDP? Is it a government expenditure-based economy? So those are important factors that will allow us to understand how any of these four components of AD may affect the whole GDP of an economy in the short-term fluctuation, but in turn will actually affect the long-run trend. So consumption leads to production. If people are consuming more, then the firms will react by trying to supply what people want to consume. We also have this assumption of homo economicus. We have the animal spirits or the animal instincts allowing us to say, well, I want to be better off, and then I will provide what the market is telling me to provide. So that will trigger more dynamism in the market, because as more consumption is induced, then the production will follow. If there are willingness to buy, then there's gonna be a willingness to gain profits from those people who are willing to buy. Also, the opposite will be true. If there's not a willingness to buy, then firms will start to stop producing, and therefore we have the opposite, and we start to see a recession coming as a consequence. Let's move on. this graph is telling us that this economy, which is the USA, is a consumption-based economy. A high proportion of its GDP is induced by the consumption of households. Remember, we said that. Actually, all economies in the world have a big proportion of its GDP because of the household consumption, okay? And then investment is just another chunk, government expenditure, and net exports, okay? This is, again, the USA, a little bit more recent, and then we see the personal consumption is this blue area that is telling us the economy is very driven on the personal consumption behavior. So anything that affects the consumption of households will affect in turn the GDP of the economy of the USA and the economy of many parts of the world, okay? Also, the government expenditure, which is this purple one, will also actually affect the GDP. If the government spends more, then the GDP will grow more. And if the government spends less, that will affect in turn the production of goods and services that were sold to the government. Private investment is another smaller chunk, but all of these are inducing the economy to produce more or to produce less. And here we have the net exports. We said that because it's above the 100, that means that they are consuming more from abroad than what they are selling in the USA to foreigners. They are spending more money to foreigners, foreign produced goods. So I'm gonna move on quicker. So CIG and net exports, remember? So determinants of consumption, we have all of these, okay? Tax rates, disposable incomes, wages. If you have wages, you will consume more. If there's credit available, the whole population will access to credit more, and higher credit will mean more consumption, and more consumption will in turn affect aggregate demand. Interest rates, if the interest rates are low, again, low interest rates will make people be willing to borrow money, and borrow money means having more access to money, to income, in this case to be paid later at a smaller cost, and the interest rate is increasing the, so this is an R actually, interest rate, and lower interest rate induces consumption, and more consumption means more AD, okay, remember, AD will be triggered because of any of these components of the AD factor. Okay. So I'm going to leave these slides for you to check because these are the exogenous determinants of each of the components of aggregate demand. Investment, again, we have machinery, expectations. If first look at the economy growing, they will invest more. Right now, nobody wants to invest in an economy that is actually facing a recession, etc. Government expenditure, we can see how the G is led by the different policies that the government needs to focus. Right now, there's a lot of government spending on health services because the government is buying medicine and masks and all these different health issues or health devices. The GDP is still on float because all these firms that produce these goods are still producing and providing jobs. So government is actually driving a lot. Some economies right now, they want to invest in education, or they will receive more aid, and the money that they receive will allow them to spend more, and spending more will mean, again, AD shifting out. So we're just looking at determinants on each of the components of AD. The rest of the world, produces, in this case, we are buying from the rest of the world if we have more money, or if the prices of the rest of the world goods are cheaper, or if the exchange rate of the other countries' currency is lower, is lower than actually we need to pay. We will receive more currency from this other country than what we have provided from our currency, and that will make us to have more chances to buy goods from the rest of the world cheaper because now we're receiving more money, so the exchange rates matter. We will talk about that next year. So etc. So all of these are different components of import expenditure. And the same thing, export earnings, why people of the rest of the world will buy our stuff. Well, maybe the country that we're trading with has a higher income, and that's why they want to buy more of our goods. That increases our X. And remember that higher X will be making the equation of x minus m more positive, and that will trigger or induce the aggregate demand to shift actually outwards, okay? On the other hand, we can enhance productivity by talking about how to increase productivity, the quantity of units per labor, or the quantity of units produced per land. This should be the quantity of units produced per capital stock. So if we increase our quantity of units with the same amount of capital or with the same amount of labor, that will mean that we're increasing our productivity of labor. Sometimes that happens if we educate more, our people are going to be more productive, they are more educated, or if we increase our capacity or technology to produce, I mean the technological changes of machinery will increase productivity. Now that will be a supply side factor. We can increase our production by adding more factors of production, but also by adding more productivity on the existent factors of production, okay? So enhancing productivity means shifting out the aggregate supply, okay? So the aggregate supply can shift out if we increase productivity, if we increase the ability of producing more, but also if there's more investment, let's say, the aggregate demand will also shift out. So we have a double shift, aggregate supply shifting out, aggregate demand shifting out, we have the new equilibrium here, okay? So because there's a new equilibrium, that means that the whole aggregate supply is shifting outwards because now we are producing more and we have more ability to produce more. I'm gonna leave this IB long essay question for you just to see how the IB is approaching to this so far. And now we have seen that how investment in, changes the aggregate demand, but also the aggregate supply, okay? And this is a part B question that we will reflect and actually explore a little bit later in our next class. Okay, let's leave it here for now.